We often hear about financial crises as something, utterly terrifying.
Mhm.
The headlines scream panic, fear grips the markets, and the numbers just drop like a stone. But what if the next massive market crash wasn't something to dread, but something to actually exploit?
It's a fundamental shift in thinking, isn't it?
It really is. That shift from victim to tactician is the core of today's deep dive.
It's a completely different approach. I
Hmm.
mean, most investors, they just suffer through downturns. They sustain these huge losses. The framework we're breaking down today is designed to help you stop suffering crises and, well, start profiting from them.
So our mission today is to analyze this A to Z action plan from our source material. It's all about long-term investing. And we're going to map out two strategies that are really interconnected.
Right.
First, building a strategic reserve, or la reserve strategic. And second, executing what's called pyramidal reinvestment, which the source calls l'investissement pyramidal,
It's basically a structured way to neutralize your own emotional reactions.
and take back control.
Exactly. But before we get into any of that, we have to cover the mandatory stuff,
The disclaimer.
the disclaimer. So the content we're reviewing is strictly educational. It's for informational purposes. It is not investment advice.
Absolutely.
Investing has significant risks, and you, the investor, are the ones solely responsible for your decisions. And always remember, past performance is never a guarantee of future results.
Thank you. Okay, let's jump in. The foundational mindset. Because before you can even think about a strategy, you have to prepare for the storm mentally. And for anyone looking at long-term investing, the biggest stress point is always, what if the market drops violently? What if I lose everything?
That anxiety is what causes people to fail. It really is. The source material is very, very clear on this. If you commit to long-term investing, and we're talking a 15-year horizon or more,
Right.
you have to accept that significant declines are guaranteed. They're going to happen.
It's not an if, it's a when.
Exactly. Historically, you're looking at drops of around 50% in a major crisis. And the recovery, that can take anywhere from 1 to 5 years. This isn't some black swan event. It's a known part of the market cycle.
Okay, but a 50% drop that lasts 5 years, that's enough to make anyone feel sick and just want to sell everything.
Of course.
So what's the golden rule this framework gives us to survive those terrifying times?
The anchor point is so simple, but it is brutally difficult to follow in the moment.
I can imagine.
Never sell when prices are low. As long as you just hold on, as long as you don't sell, the loss is only on paper.
It's not real yet.
It's not real yet. You're giving the market the time it needs to recover. The second you hit that sell button when you're down,
Yeah.
you turn that paper loss into a permanent, real financial disaster.
So it sounds like this whole thing is designed to stop us from acting on our own worst instincts. What are the specific mistakes people make that sabotage this?
The source highlights 5 really common errors that just crush investor performance. The first one is very relevant here. Investing everything at once without a safety net.
You go all in.
You go all in,
Mm.
and that leaves you psychologically and financially totally exposed when the crash hits. You have no options.
And no options leads to panic.
That's it. The second error is investing money you know you're going to need in the short term.
Right, like for a house deposit in a year.
Exactly. Market recovery is unpredictable. If you need that cash in 18 months, it should never be in volatile assets. The third is the panic selling we just talked about.
Okay.
And the fourth is constantly changing your strategy based on every news headline or, every feeling you have.
Sitting in the market.
Yeah, you just introduce chaos into a process that needs discipline.
And what's number 5?
Trying to beat the market without any real experience or edge. I mean, this framework isn't about picking the next Apple or Tesla. It's about a tactical plan against the broad market during its emotional cycles. The whole system is built to avoid those 5 traps.
Okay, so let's move to the thing that protects us from those mistakes. The strategic reserve. Let's unpack this. Why does the entire approach hinge on this distinct liquid reserve? Why not just use your regular emergency fund?
That's a great question because the purpose is different. The strategic reserve is for strategic leverage, not, fixing your car. It provides mental assurance, which is huge, but tactically, it's the ammunition you need to intelligently exploit opportunities. When the market is down 30, 40, 50%, assets are on a massive sale.
And if you have no cash, you can't buy anything.
You miss the sale. The reserve ensures you have the firepower when everyone else is completely paralyzed by fear.
So it's not passive safety, it's an active war chest. The source suggests a specific size for this reserve, a classic recommendation of 30% of your total investment capacity. Why 30? Why not, say, 10 or 50%.
It's all about balance. If you hold 50% of your capital in cash, you suffer a huge drag on your performance during the good times, the bull markets.
Right, you're missing out on all that growth.
You're losing years of compounding. But if you only hold, say, 10%, your ability to really make a difference during a severe crash is just, it's too small.
You risk missing the boat.
Precisely. So 30% seems to be the sweet spot. It's substantial enough to make a real dent when you deploy it. And we'll get to the pyramid part, but it still lets 70% of your capital stay invested and grow over the long term.
That makes sense. It's an optimized compromise. So where should this money live to make sure it's liquid and protected?
It has to be totally safe from volatility. So we're talking about regulated secure accounts, maybe some low-risk life insurance products, or high-quality monetary funds. It has to be accessible pretty quickly.
Like within a few days.
A matter of days or weeks, yeah, when you see the market starting to bottom out. But it cannot be exposed to the market itself. And the critical rule, the absolute critical rule, is this 30% is for investing opportunities only, untouchable for daily expenses.
That discipline right there. Dedicating capital only for downturns. That's what shifts the whole perspective of a crash from a disaster to a clearance sale. Okay, so we've got the 30% safety net. Now, this is where it gets really interesting. How do we deploy it using pyramidal reinvestment?
The pyramidal structure is, I think, genius because it removes all the guesswork.
Right.
The rule is, the deeper the market falls, the larger the chunk of your reserve you invest. It's completely counterintuitive. You're actually increasing your exposure right when fear is at its absolute peak.
Which is something you never do on your own. You'd hesitate. Fear would be screaming, wait, it might drop another 10%.
Always. And that's why the pyramid is so important.
Yeah.
The objective is to define in advance exactly how much you will deploy at specific thresholds. Minus 10%, minus 20, minus 30, and so on. So when the news looks like the world is ending, you don't panic. You just check your pre-written plan and you execute step 3.
Let's use the example from the source. It maps out a hypothetical 1,000 units of reserve capital for a really bad crash down to minus 60%. Why are the initial investments so small?
Okay, so look at a minor correction, minus 10%. The plan only triggers a tiny deployment, like 1% of the reserve. So 10 units of capital.
Just a little bit.
A tiny bit. And this serves a crucial function. It hedges against what's called a false bottom.
Right.
A 10% drop could just be a blip before it recovers, or worse, before it drops again. By investing only 1%, you're testing the waters, you're not committing your ammunition.
But you're saving your firepower for when the prices get really, really attractive. And as the fear grows, say the market slides to minus 30%, now you're in a real bear market, the deployment gets much bigger.
Correct. By minus 30%, the investment tranche might jump to, say, 130 units of capital.
Yeah.
That big increase recognizes that the odds of making major gains from that point have gone up dramatically.
How?
And then you look at the catastrophic scenario, the minus 60% collapse.
Yeah.
That's where you deploy the largest tranche of all, maybe 340 units, and you exhaust the rest of your reserve.
You're buying the most when the asset is the absolute cheapest. This whole framework, it perfectly captures that famous Warren Buffett idea. Be fearful when others are greedy, and greedy when others are fearful.
Yes.
When the market is having a fire sale, you have the cash and, crucially, the pre-written plan to be the greediest person in the room.
And this brings us to what is, I think, the most important realization. This isn't about choosing between regular investing or waiting for a crash.
It's about doing both.
It's about doing both simultaneously.
Because that's the dilemma for most people, isn't it? They either commit fully to dollar cost averaging, DCA, investing the same amount every month no matter what.
Right.
Or they sit on the sidelines with all their cash, waiting forever for the big one and just missing years of growth.
They fall into that trap of prioritizing either time with DCA or timing by waiting. This combo approach integrates both. Your regular disciplined investing, that's 70% of your capacity, that's what makes sure you benefit from the market's general upward trend.
That gives you serenity.
It gives you serenity. You know you're always in the game, always accumulating.
And the 30% strategic reserve is your timing tool.
Exactly. That's your surgical firepower for the big dips. It lets you reinforce your positions when prices are at rock bottom. So by combining the 70% for time and the 30% for timing, you get both resilience and much better long-term performance.
Let's run the numbers on that again, because this is the real aha moment.
Yeah.
If you're putting in, say, $200 a month with DCA and you have a $6,000 strategic reserve, The market suddenly drops 50%. Your pyramid plan says to deploy $4,000 at that point. What does that one massive investment actually do?
That $4,000 is the equivalent of buying 20 months of your regular $200 investments.
All at once.
All at once, and at a 50% discount. I mean, just think about how much that one action drags your average purchase price down across your entire portfolio.
Right.
It means when the market does recover, you start seeing profits way, way faster than the investor who was cash poor and just kept plugging away with their normal $200. It just accelerates everything.
That's the beauty of it, using the downturn to get things cheap. But okay, now there's a critical challenge. You've used up your reserve during the crash. The market is starting to come back. You can't go into the next crisis with no safety net. How do you rebuild it?
This reconstitution phase is just as tactical as the deployment phase.
Mm-hmm.
The goal is simple. Rebuild your liquidity in stages without selling too early and sacrificing all those gains you're about to make.
Okay.
So let's assume a big 50% drop and we've deployed the entire reserve.
Right, the war chest is empty. So when does the plan say to start taking some profits to rebuild that cash?
It uses recovery triggers. Phase 1 is what we'll call halfway recovery. This means the prices bounce back by 50% of the crash. So if it dropped 60%, it's now only down 30% from the old peak.
But the risk is still there. It could drop again.
The risk of a dead cat bounce or a double dip is definitely still there.
So what's the move?
You sell just enough of your investments, like your ETFs, the easy stuff to sell, to reconstitute 1/3 of your reserve. So that's 10% of your total portfolio back in cash.
Ah, I see.
The logic is crucial. It gives you some early liquidity in case another crash happens before you get back to the peak. Meanwhile, you keep deploying 100% of your new monthly savings into the market to scoop up assets while they're still discounted.
So you're taking a little bit of profit for security, but you're still pressing your advantage with new money. What about phase 2, return to the old peak?
When the price finally gets back to where it was before the crash, you make the second, bigger move. You sell enough to rebuild 2/3 of the reserve, 20% of the total portfolio, and you lock in those profits.
That's a pretty big move. Does your monthly investing change here too?
It does. This is a vital change. You drop your monthly DCA back to the planned 70% and the other 30% of your new contributions. They now start flowing directly into the strategic reserve, refilling it month by month from your savings.
I see. So the reserve is being refilled from 2 directions now, from selling appreciated assets and from fresh monthly savings. And the final step is phase 3, new heights.
Correct. Once the price goes past the old peak by about 25%, meaning the bull market is clearly back, you make the final sale to fully rebuild the entire 30% strategic reserve.
And from there?
From that point on, you're back to your system. 70-30 split, 70% DCA, 30% held in reserve, ready for the next time the cycle inevitably turns.
You know, this whole deep dive just reveals the immense power of preparation. This isn't just about market trends. It's about a disciplined plan to eliminate the most destructive factor in investing, which is our own emotions.
It is.
By pre-committing to a plan like this, a pyramidal reinvestment with a strategic reserve, you really do transform yourself from a panicked observer into a financial tactician.
That transformation is the whole point. The source material calls this neutralizing the enemy number 1, yourself. You replace the terror of a crisis with a clear, quantified plan. It forces you to be disciplined and, as we said, greedy when everyone else is terrified.
So as you finish this deep dive, here's a final thought to consider. If applying this kind of advanced financial plan requires such strict, pre-committed steps just to defeat our natural instinct to panic, what other high-stakes areas of your life, maybe career moves, difficult negotiations, or just major personal goals, could dramatically benefit from building a defined, emotion-proof tactical plan long before the moment of crisis ever arrives?